Starbucks, stock ticker SBUX, was expected to deliver a strong earnings result the last time, and they did not disappoint. They beat both on the top line and the bottom line, 9 cents on the bottom line and 90 million on the top line. Especially strong sales in the United States, led by 12.5% growth year over year, and comparable sales rising with 8% delivered that strong result. They are currently trading at $102.65. Year to date, they are up roughly 2%, but if we zoom out a little bit, they are up roughly 21% over the last year. You can see here at the end, it's roughly for the last 5 days, they took a pretty big jump, around 10% actually. Dividend-wise, they are also looking really strong. Starbucks actually raised the quarterly dividend by 7.5% to 57 cents not too long ago, back in late September. And if we look at some of the dividend stats based off that, you can see currently they are offer a 2.22% dividend yield, annual payout of $2.28. Payout ratio sits around 60%, which is looking pretty good, okay, and the 5-year growth rate around 11%. Dividend growth streak of 12 years. And if we jump into the dividend history, you can see it's basically how I want it to look, up and to the right. And as you can see here, they recently raised the last dividend, which will be paid out in a few days. We also want to take a look at the financials to see whether or not the dividend could be in jeopardy in the future. So if you take a look at the financial statement, in the income statement, you can see revenue, they are growing extremely well. 24 billion 5 years ago, up to around 34 billion in the last report, just a few months old actually. And then going down here, you can see net income also looking pretty good. They had a pretty meager year during COVID, obviously, but up from 3.6 billion to 4.1 billion. So they are also growing on that regard. And if we jump into the cash flow statement and coming down here a little bit to find the cash from operations and the capital expenditures, we want to take a close look at the free cash flow they are generating. So if we take a close look here, again, during COVID, obviously it was quite low, but they have raised it roughly 1 billion back from 5 billion in 2019 up to 6 billion. Now, with the capital expenditures only rising 0.5 billion, so generate more cash flow, and that is something we really want to see, because I think dividend-wise, Starbucks is an extremely good stock. They are really focused on the dividend growth and also giving back to shareholders, which obviously we as shareholders want them to do. And another way they are delivering value to shareholders is by buying back shares. You can see here, total shares out on filing have decreased 1.18 down to 1.14 over the last couple of years. Not a huge amount still, but they are buying back, which increased the free cash flow per share and thus makes the dividend way more safe. Before we jump into our own intrinsic value calculation, I do want to take a closer look at how Wall Street thinks about it. And if we take a closer look here, you can see they have it rated as a buy, pretty close to a hold actually. And if we go to the analyst breakdown over here on the right, 33 analysts covered in the last 90 days, 9 on the strong buy side, 3 on the buy side, so total 12, but still 21 on hold. There's 0 analysts on the sell side at the current time. Jumping down here to the price target, you can see it's only actually a limited upside of around 8%. We do have some of the lows coming in actually below the current level, so I do believe we could see some sell-offs in the coming weeks or so from investors, but still there could be a potentially good upside still, a little bit at least, but again, then you are buying probably in at a pretty fair value, depending on whether you want to have this dividend coming into your portfolio in the near future. Let's jump into our stock screen and zoom in a little bit so we can see everything a little bit better. We do have some of the key metrics here. You can see the EPS have grown over the last 5 years, which is something I really want to see, because that means they are growing the business, very sustainable business model. The 52-week high, 52-week low, we are roughly sitting in the middle. Net debt to EBITDA is sitting around 3. I am not in doubt about anything about this. The way Starbucks works is they have these prepaid cards, so they are actually functioning as a bank, and they have an extremely large capital on those cards of prepaid money from customers already. You can see analyst target price is not that much higher than what we are now, roughly $10 from the current level. Return on invested capital, return on equity, return on invested capital looking pretty good. Return on equity, double check whatever happens here, because obviously you don't want them to have a negative 50%. So obviously something is afoot here. Something to check out if you want to take a closer look at Starbucks. Looking at some of the margins, you can see here, I'd really like to see here, profit margin sits at 11.5%, also operating margin growing over the last 5 years. That is something I really want to see. Also checking here, payout ratio just below 60%. So again, they are sitting around that 60% mark. But let's jump into the dividend data tab, zooming in again a little bit more so we can see everything a little bit better. So what we're looking for here is basically some steadiness in these dividend increases. So as you can see here, dividend growth rate over the last 10 years is 17%, but over the last 5 years around 10, and again for the last 3 years, 9. So obviously there's a bit of discrepancy here. Looking back through some of the older numbers, you can see they raised it by 23%, 25%, and so on. Not sustainable, obviously, for a total future or total amount of time, but now we're settling around these 8, 9, 10%, and I think this is still an extremely nice growth of the dividend, but still this is probably more what we should expect, or probably maybe a little bit less, around the 0.5 they used for the last time. Coming down here to the dividend yield theory graphs, you can see here over on the left, it could indicate there's a bit of discount, and if we look over here, again, whenever we are in the blue area above the line, then it could potentially be undervalued. Obviously, there's no number here, but I know this is roughly 7%. And when we go into our summary later, I also want to show I've actually included this dividend yield theory in that. So there's another valuation model we are using for our average, but that is for a little bit later. Now I do want to go through all the different valuation models we do have. Obviously, I don't want to go through every single one of them, zooming out so you can see all the details. You can pause the video if any time you want, if you have to take a close look at some of the estimates and some of the details or final numbers or anything I've put in. We do have the multiples valuation, also Graham's revised, the price to earnings valuation model, free cash flow valuation, the Peter Lynch formula, and so on. Before we jump into the summary, thank you so much for watching. If you haven't done so already, please subscribe to the channel for more videos in the future. Now let's jump into the summary where we do have all our different valuation models. And as you can see here, as mentioned, we do include the dividend yield theory. I found out a way I could export that number in here so it would make sense. Obviously, we can still exclude it if we want to, but again, in this case, obviously we do want to have it here. So the way that it works is obviously we do have all of these valuation models that we sum together to get an average intrinsic value of just over $100. The discounted cash flow model is a bit off, I think, so you could potentially remove that if you want, but again, I still think it's pretty okay because we do have the dividend discount that is maybe a bit too high, obviously, so the discounted cash flow kind of keeps that one in check. So the average intrinsic is, as mentioned, just over $100. With the current price being $102, I would say it's fairly valued at the current time. Obviously, we also want to apply a margin of safety down here in the empty spot. So over here on the right, we do have our margin of safety calculator. Starting with a standard of 25, we either add or deduct a little bit of margin of safety based on some of the key metrics we saw earlier, such as EPS growth, payout ratio, and so on. In this case, we do subtract 10, 5, and 10, based on some of the key metrics, which gives us a margin of safety of 0. And I think actually for StarBucks, that is a good enough stock and a great company that I would probably still be okay buying shares here without a further margin of safety. So putting in just 0 here, which shouldn't change anything, and it doesn't, which is great, the acceptable buy price becomes $100, obviously, which is pretty close to the current price. So personally, in my humble opinion, this is fairly valued at the current time. I do agree with all the analysts saying that this is a hold. I would probably, if you do have a low average cost, I could probably still nibble some few shares if you want to at the current levels. I don't think it's overvalued still. It's getting there, but not yet. So still at the level, I would be perfectly okay adding a few shares here and there. Starting a totally new position, again, could be okay, but I would probably wait a little bit to see if there are some sell-offs based on the earnings report. But as mentioned, it just came out not too long ago, if I can find the right tab here. As mentioned, it just came out a few days before. So if we zoom out just 6 months here, you can actually see it had been on a bit of a downward trend. So maybe there could be a sell-off based on this jump here. So I would probably wait a week or two before starting a totally new position. But that is obviously up to me, obviously up to yourself. Thank you so much for watching, and I'll be seeing you in another video.